Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy any investment based solely on a tip or recommendation. Please do your own research.
Hello and welcome to the Sunday Roast. It's Sunday the 6th of July. I'm Phil Carroll.
I'm Kevin Hornsby.
And the season finale of the roast. Well-earned break for summer, and it feels like summer is truly underway. It's been absolutely scorcho this last couple of weeks, Kevin. We whinge about it every single week, it seems. But yeah, I think AC needs to be installed, mate. It really is. How's life over there in Egypt?
Yeah, Phil's trying to escape, by the way. There probably is going to be one more roast, but we're saying, because we've got a big guest, this could be the last one until September. But anyway, and we're still going to be here with midweek takeaways and all the rest of it, but the Sunday roast will take a break for 6 or 7 weeks. Yeah, it's bloody hot here. My head's recovered now, hopefully. So yeah, still got memory loss, but I think that's my age, not the head knock. But yeah, what about it? Mr. Jota got into his Lamborghini and he's no more.
Yeah, that was terrible news, wasn't it? We saw that on for our Thursday morning. Saw the news. I think I sent you the screenshot on the phone. Yeah, I mean, what do we know? So far, we know that he was on holiday on the Spanish-Portugal border. And apparently I do a lot of road trips over there. I know a lot of the roads around northern Spain and into Portugal. And apparently it's not a road I've been on, but it's certainly one that has been touted as one of the most dangerous roads in the area. I don't know whether that's just down to the intersections. But I mean, obviously, all we know apparently so far is that there was some sort of blowout on one of his tyres. And again, this could have been early speculation, but this is what the new media outlets reporting. Blowout on one of his tyres. Car went into a ditch and turned over, and unfortunately the ensuing fireball resulted in the death of Diogo Jota. Now, apparently his brother was in the vehicle as well. I don't know if you know about Andre Silva, who is his brother, who apparently is also a professional. I don't know which club he plays for. I think they're both Portuguese, but obviously both professional footballers. So again, thoughts to his family and friends. But it just goes to show you, I said to you, life is precious, mate. You just don't know. I mean, I drive fast cars all the time, and it does think it's sometimes in the back of your mind. If you experience a blowout, you've no chance. Not at speed.
No chance. He joined in 2020. He wore number 20, and he won as number 20. That was the tribute from Liverpool. In terms of, in the last couple of months, he's won the league with Liverpool. He won the European Cup or trophy with Portugal, and then he got married 11 days ago. He has three young children, all under 5 years old, and bang! Life is fragile. Let's put it that way.
Absolutely.
So
Yeah, I mean, obviously, a quick one before we get going with our guests this week, but please make sure you subscribe, give the episode a like, and hit the bell icon so you get notified the second a new one drops. Every bit of support helps us keep this going. So let's welcome our special guest this week. We're delighted to be joined again by Rick Rule, CEO of Rule Investment Media. Welcome back, Rick. It's great to see you again. How's life treating you?
A pleasure to be with you. My life is very busy right now. I next week report to the Rule Natural Resources Investment Symposium in Boca Raton, Florida, to join 2,000 of my closest friends, live and online. So I'm a very, very, very busy. Well, I can't describe myself as a lad. I'm a very, very, very busy old codger.
I like that. And well, we will first start by thanking you for your time then. We appreciate how busy you are. And yeah, it's great to have you on. So let's get started. I mean, we normally start with a little bit of politics, right? And we don't want to go too deep into politics. But last time you were on, we talked trade tariffs or Trump tariffs, and I want to talk a little bit about the 3 Bs, as I call them, the big, beautiful bill. And that, there's a popular adage that the president proposes, but, Congress disposes. And it may yet be that Congress will dispose of some of Donald Trump's tax cutting plans. But, the US is going to run a fiscal deficit of around 6% of GDP for the foreseeable future. I mean, that is huge. And you don't need to be interested in American politics to think that this number, cannot be sustainable in some way. And if we look at the UK, I think the numbers here are, with Rachel Reeves is under huge pressure to hold the UK deficit from last year is about 4.8% of GDP. There's only a handful of countries that could claim to be physically solid, that, you know, that can cover the interest on their national debts and over time to get the number down. But I heard someone say recently, government deficits don't matter until they do. So what are your thoughts on the whole situation with the big beautiful bill and what it means for the US debt?
Well, you said a lot, but let's take it from the back, which I remember. They don't matter until they do. Hemingway once was asked, the author, how, despite all the money he made writing books, he went bankrupt. And he said, slowly at first, and then all of a sudden. My friend Brent Cook, who I believe you know, spectacular geologist, trained in finance under me, so I think he was well trained, was saying, you know, I've been hearing you gold bugs talk about the impact of debt and deficits for 40 years, and nothing's happened. Why should I believe you now? So I'll tell you why. In 1982, on-balance sheet liabilities of the United States, which is to say the debt that we owed bondholders, was 30% of GDP. Now it's 120% of GDP. In 1982, the start point referenced by and I'm not being sarcastic, by my friend Brent Cook, the net present value of off-balance sheet liabilities, which is to say entitlements, Medicare, Medicaid, Social Security, was about 1 times GDP. Now it's 4 times GDP. Aggregate liabilities in the United States, on balance sheet and off balance sheet, are the equivalent of 4 or 5 times GDP. What has changed is that we're running out of string. Now, what has happened in the last 50 years, really, is that the dynamism of American society, our ability to produce a society where 4 or 5 kids take over a garage in Sunnyvale and out pops Google or out pops Apple or out pops Microsoft, has meant that we can enjoy economic growth with less capital investment than at other points in time in our history, and frankly, in other countries. We are a high margin economy. What I would tell my friend Brent Cook is that for 40 or 50 years, the creativity and tenacity and brilliance and hard work of the American individual has funded our collective stupidity. But it gets increasingly difficult to do that. And I think the people who say that deficits don't matter are the people who, like Hemingway, went broke slowly and now are going broke all of a sudden. I would urge your listeners, and I'm sorry to beat this to death, but this is the most important issue of our time, I think. Many voters, those who are numerate at all, confuse solvency and liquidity. It's as though in US dollar terms, they're making 60 or 70,000 a year, but they're $1.2 million in debt. They have $10,000 in their jeans, so they can buy a cup of Starbucks. They're liquid, but they're not solvent. Those are very different words, liquid and solvent. The US is hugely liquid on the private side, but we're insolvent on the public side.
Yeah.
And that's something that the whole world has to understand. The US dollar is and will remain for my lifetime. For reference, I'm a healthy 72-year-old. The world's reserve currency, but American hegemony will be reduced. I believe that the US dollar will continue to perform reasonably well relative to other fiat currencies. But in an absolute sense, I would be very surprised if the purchasing power of the US dollar didn't decline by 75% over 10 years.
Well,
there's a prologue for this. That's what happened in the decade of the 1970s. In the 1970s, 1970 to 1980, not according to some cranky old libertarian named Rick Rule, but rather according to the U.S. Congressional Budget Office, then called the Office of Management and Budget, the purchasing power of the U.S. dollar declined by 75% in 10 years. Mm. Not coincidentally, the gold price ran from a price-controlled $35 to $850. Now, the latter number was stupid. That involves speculators being as dumb as speculators always are at the top of the market. But it wouldn't surprise me if the nominal price of gold rose by an amount that is commensurate with the deterioration in the purchasing power of the US dollar. Bringing it back to your podcast.
Yeah, well, I mean, US dollar is down, what, 11% against most global currencies this year. I have clients who pay me.
That's a floating abstraction. Down 12% against a coalition of lies. Understand that your currency, the pound, the euro, the Swiss franc, the yen, the renminbi, they're all floating abstractions.
Oh, yeah.
Some of them are floating abstractions behind very good franchises, and some aren't. I'm much more interested in the relative declines in purchasing power behind these fiat abstractions. The fact that the US dollar does well against the Canadian dollar or the Australian dollar or the yen or the renminbi is an amusement to me. But what I'm concerned with is maintaining the purchasing power of my savings and having society maintain the purchasing power of their salaries and savings. And that is going to be a real challenge in the next 10 years.
So here's a question for you. Let's say you're right and I actually agree with you. The fiat currencies are going down and down and down. People pile into gold. Does that make gold overvalued as the currency? If the currency starts to collapse all at once or go bankrupt all at once, is there a risk there that you're going into gold when it's too high relative to the other currencies?
Yes, there's a risk, but it's an acceptable risk relative to the guarantee on the other side of the transaction. Yeah. I personally save in gold, but I maintain a lot of US dollar liquidity. I think those are very different topics. I know that my US dollar liquidity is costing me purchasing power.
Yeah.
I get paid, 4.5% in, a little less actually, 4.3% in very short-term treasuries, in a currency where my purchasing power is declining by 7.5 or 8% a year. So my liquidity is costing me 3.5 or 4% a year. I get that. I am willing, although not happy, to accept that negative yield because I consider the negative yield to be an option premium. If I have liquidity and we have a liquidity-induced market squeeze, I will take advantage of the circumstance rather than being taken advantage of. I remember well the year 2009 after the 2008 collapse. I went into that psychologically prepared and financially prepared. The consequence of that is that 2009 was the single best investment year of my career. And I believe personally that the negative return that I receive on my liquidity is, as I say, an option premium, giving me the ability to take advantage of economic turmoil rather than being taken advantage of.
Last question from me for a minute. I'll then jump in. If you were the president of the United States and you wanted to, quote, fix the currency.
Don't do it, Rick. Don't do it.
I just genuinely, I think maybe you can peg the dollar to gold and it would be very, very bad, but would it be less bad than letting the devaluation of the dollar as it continues stand? What would you do?
Charles, if I was elected president, the first thing I would do is demand an immediate recount.
No, but you laugh, but actually a lot of us have the same concerns. I'm saying, not just us on this little podcast, around the world.
There's at last count,
the best
at last
answer.
count, there's 470 million guns in private circulation in the United States, and I'm an old, fat, slow target.
Rick, I have a question in terms of the price of gold and just what we see as its value, okay? Because if we're valuing it what we perceive as nonsense, whether it's the US dollar, whether it's the British pound, whether it's the Australian dollar, whether it's the Canadian dollar, whatever, how do we actually view our buying power? How do we ascertain what we can actually buy with things if we've got this moving target? And I'll throw it in there as well. What about this supposed store of value with Bitcoin now as well, or any cryptocurrency, which effectively is no different than the fiat currency? It's not backed by anything. It's not a physical thing, but there is a limited supply.
I think there is utility in Bitcoin, although I don't understand that utility well enough to own it. There is a network effect. There is a transactional efficiency. It isn't always present in the market, but there is a theoretical transactional efficiency in Bitcoin. And there is, as I say, that network effect. There is also, right now, some element of anonymity and privacy, although the Bitcoin adherents would ironically like to remove the benefit of transparency in hoping to get government backing for Bitcoin. They're sort of like penny stock promoters in that regard.
Yeah, that's because the governments want their tax from it, for sure.
And so I understand the utility. I don't own Bitcoin, I guess because I'm old and because I've read Aristotle. The idea that gold has value in and of itself. It's had the same network as Bitcoin has, except for that it's had it for 5 millennia. It's durable, it's divisible, it's malleable, it's indestructible.
That's actually a debatable point, because if someone pulls the plug on the internet and the whole sort of electronic world that we live in, it isn't indestructible, it's dead.
Well, you're talking about Bitcoin.
Yes.
No, I was saying that gold
is malleable. Gold, yeah.
I was saying that gold is indestructible. The truth is that there are no certain answers in life, other than, of course, death and taxes. What you do is you look at the circumstance that you find yourself in, and you speculate in probabilities. I don't know enough about Bitcoin. I don't have any durable competitive in terms of my knowledge about Bitcoin relative to other participants. So I'm not in that market.
But my initial question was, how, regardless of the Bitcoin, how do we actually, in this current climate and in this situation, and has this happened before, where we just truly don't know what the buying power of these things are anymore?
We certainly measure the price of gold in the floating abstraction that we live our lives in, in. In other words, we base our sense of the price of gold on a floating abstraction. You have to deal with that in your life. Coming in to the 2000s, I sort of sat down and I had a talk with myself. I said, this is what you've done. This is what's worked. This is what hasn't worked. What are you going to do with your life, with the rest of it? A pretty thoroughgoing conversation. And one of the things that I decided, gold was very cheap then, $250 something an ounce. And I'd gone through the ups and downs of the gold price. I reread Aristotle, and I paid some attention to gold markets in my lifetime. And I decided that one thing that I would do is keep an alternative set of books for myself and my family. The official set of books, the ones that I pay taxes on, are denominated in US dollars, of course. But I began to systematically save in gold. And I began every year to recharacterize my assets, my liabilities, my savings, and my expenditures in gold. And that's been an extraordinarily useful exercise for me. When people say to me on podcasts like this, or they don't say it now, but 2 years ago, they say, or 3 years ago, when's the gold price going to move? And I could look at them with a very straight face and say, well, the gold price is going to move in 2000. It has increased in price by 8.5% compounded for the last 20 years.
So I'm sure that's a very interesting thing then. Your expenditure in gold must be decreasing every year.
That's correct. If you denominate your life in gold, what you see is that real pricing, in your terms, is decreasing. Rents are decreasing. Health insurance is decreasing. Groceries are decreasing. Gasoline is decreasing. It's very interesting. And it makes you particularly questioning of maintaining your liquidity in US dollars. It calls into very, very, very stark contrast the difference between the true yield that you receive and the deterioration in the purchasing power that you experience in fiat currencies. It's a wonderful consciousness raising exercise.
I think you said last time you were on, Rick, that a little bit of gold goes a long way, and something along the lines of, had you in 1970 had 5% of your portfolio in gold, you could have lost 50% of your equities and bonds and still broke even. So how do you feel that do you still have that same theory now? Would you, do you have more than 5% of your portfolio in gold?
I do, which is stupid for me. It's stupid because my life is tied to gold in so many ways. I'm still the largest shareholder of Sprott, which I would suggest is one of two worldwide brand names for precious metals investment. To the extent that the gold price does well, my Sprott stock will do spectacularly well, which it has. I also have a disgustingly large percentage of my portfolio in gold mining stocks, but that's my trade. That isn't just an investment. It amuses me. And speculation in natural resources is how I ended up with an economic surplus to save in anyway. If a rational financial planner looked at my portfolio, even assuming that financial planner was not unsympathetic to gold, he'd say, Rick, you're out of your mind. Your income will go crazy in the kind of gold market that you're forecasting. You don't need to own gold to protect yourself. But the truth is that I believe that the essence of money, the essence of wealth, is enhancing your sense of well-being. And I can tell you from the bottom of my heart that gold helps me sleep nights and stay calm. And that's a wonderful attribute at age 72. Sleep doesn't come naturally.
Very good.
The gold's not under your mattress, is it, Rick?
Yeah, you wouldn't sleep very well with that, would you?
Sure. No, I've had a lot of clients over my lifetime that have stored their gold informally. I call them midnight gardeners. And that exposes you to a very different set of risks. People who you normally wouldn't invite over to lunch, who come to visit you with firearms, preferring that your gold become theirs. I don't do that.
No, that's fair.
What's your thoughts then when we talk about gold? What's your thoughts on the silver market then?
In my experience, precious metals bull markets are led by fear buyers. They're led by gold. When the momentum in the gold price first moves the best gold equities, which we've seen in the last 18 months, and then moves down to the mid-tier gold equities, the generalist investor becomes enticed with the precious metals narrative. When the generalist investor comes into our space, market leadership, and I'm not sure why, I suspect it's the lower unit price, market leadership switches from gold to silver. I've watched it happen 3 times before in my career. By the way, when that happens, you won't need Rick Rule to tell you that it's happening. It will be very, very, very obvious. As I say, I don't know why leadership switches to silver, but it does.
When do you envisage this happening? Because I mean,
I have no idea.
But it looks very much like it's set up in exactly the way that the last 3 times have happened right now.
I agree that the setup is in place. I think we're in a precious metals bull market that is likely one for the record books. More dramatic than the 2000 to 2010 market, more dramatic than the 1998 to 2006 market, for the reasons that we talked about at the beginning of the show. And I'm reasonably certain, although I don't know why, that history will repeat, in the sense that at some point in time, the generalist investor, who, by the way, does not yet know how to spell gold, will come down into our space. And when they do, I would suspect that the price appreciation that you will see in silver will be as dramatic as it has in the past. And when I was a younger man, ironically, I had more time on Earth and I was less patient. I concerned myself a lot with the why question, or not the why question, I'm sorry, the when question. I, like everybody else I observed, had a track record unblemished by success in terms of anticipating the when. And I remember reading a Warren Buffett quote in one of his wonderful annual reports, where he said that forecasting markets is a complete waste of time, that you can allocate 15 or 30 minutes, a week to it for your amusement, like you do the crossword puzzles. But devoting more time than that to it was, quote, trying to know the unknowable. So I don't do it. I concentrate on asking myself questions where the answer begins with when, not if. And I understand that if I speculate in probabilities where the upside is truly spectacular, the when becomes less important. Let's say that I believe that gold will take out its former, or silver will take out its former all-time highs in real, not nominal dollars. Okay, that it will take out its all-time highs in $1980. In fact, let's say that I think it'll only go to half its all-time high in nominal dollars. That means that the silver price from here triples or quadruples. Now, while I would like to know when that's going to occur, I can't. If I got a quadruple or a triple in a year, would that be good? How about 2 years? Would 3 years be a sufficient amount of time to wait for a triple or a quadruple? The truth is that people who can't familiarize themselves with those probabilities are people who would be best off still believing in the tooth fairy.
I like that.
You're right, but a lot of modern day investors, certainly in the small cap arena, won 5 times in a weekend.
Which brings us on to the next. Which brings us on to the next subject, Rick.
Precisely why I outperformed them over a decade.
So the next thing I want to talk about, I mean, there's been a massive explosion in a few stocks in the UK space, really kind of based on an American principle or an American theory from a company called MicroStrategy. I don't know if you know much about. I assume you do, Mike, the Sayer. But basically, it's where a company builds a Bitcoin treasury strategy, and they hold Bitcoin within the company itself, and they effectively raise money, buy Bitcoin, and then as the treasury grows and the value of the Bitcoin increases, they can then use the flywheel effect to raise more money, buy more Bitcoin, and it continues and continues and continues, and the value of the company grows. We saw a company called the Smarter Wed Company recently IPO around about 2.5, 3 pence, and they hit about £4 or £5 a share within, I don't know, 6 to 8 weeks from the IPO. It's probably they've been the most successful IPO on the UK market. And they have something called MNAV, which is multiples of the NAV. They're effectively leveraging against the value of the Bitcoin. Do you know anything about this? Do you have any thoughts on these types of company?
I've talked to Michael Saylor. I'm personally not infected by fear of missing out.
Yeah.
I'm delighted when other people make money, and I have no temptation to follow them into circumstances I don't understand. I know a lot about conventional financial services. That's why I'm starting a bank. I know a lot about natural resources. I don't know very much about technology. I don't know much about communications. I don't know much about unconventional financial services. So I don't go there. I am delighted that people have made money with this. I'm delighted that, Saylor has enjoyed such success and made so much money, provided that people take the time to sell at some point in time with MicroStrategies. And I have absolutely no temptation or inclination to buy. My experience has been, Phil, that when people are attracted in as manic a fashion as they are to leveraging what seems to me to be a technological abstraction, that I am not getting into a market that's underbought. And so if I were interested in Bitcoin, the fact that it's gone since the time that I became aware of it for $10 a coin to $100,000 a coin is not the sort of thing that attracts me. But ironically, the broader public seems not to be attracted to a narrative until the underlying price action of the subject of the narrative has gone so far that it's obviated the narrative itself. If I'm right about the gold price, and if in 10 years the gold price goes in a nominal sense up fourfold, mirroring the deterioration of the purchasing power of the US dollar, I would suspect that after that move, gold will be astonishingly more popular than before the move. In other words, with regards to financial goods, the length and breadth of the world's population would prefer to overpay rather than underpay. And I try, not always successfully, to be on the other side of that trade.
Here's a question for you, because I've been thinking about the way you're talking about gold. Let's say you're the average pay-as-you-earn schmuck, and you're earning sort of 70, 80,000 a year, right? Should you, when you get paid and you've paid off your, your mortgage and your bills, and you've got your, discretionary income left over, should you immediately be converting that into gold via an ETF or an ETC, and then just cashing it out as and when you need it?
Some of it, absolutely. Some of it, absolutely. I mean, the first thing that you do, by the way, if you're an American and you have a 30-year mortgage at 3.5% or 4% fixed, don't ever pay off the mortgage.
No,
that's free money,
forever and ever. Yeah.
If you're paying a 3.5%, and you can even go into U.S. Treasuries at 4.5%, why on earth would you pay off the 3.5% mortgage?
It's funny, isn't it? My sister, she has a 2.5% mortgage for 30 years. There's 25 years left.
Well, that one's a no-brainer. Don't pay that.
And she's never leaving that house. She'll die in that house. So.
I had a client many years ago who was literally a rocket scientist. He worked at Lawrence Livermore Labs in California. Very, very, very bright guy. And he came to visit me, and he wanted financial advice. And I told him, I don't do financial advice. That's not what I do. He says, that's okay. I'm a good client. You're going to do it for me anyway. And one of the things I discovered is, and this guy earned a lot of money. He had a reasonable net worth, and he had $200 and something thousand in credit card debt. And I said, hey, Doc, normally I can't help people, but I can help you. I know something where I can guarantee you 22% compound annual internal rates of return for a long time. I mean, this is the best idea I've had in a long time. He said, he was just crazy, like white on rice, really greedy. So what should I do? Pay off your goddamn credit cards. Yeah. I mean, you're paying 22% on revolving consumer interest, and you're using some of the proceeds to speculate in penny stocks.
But isn't this though? Isn't this
give your head a shake?
It's not just America, it's UK, it's Australia. It seems everyone around me, right, is people don't think about the cost of something, they think about the monthly payment. And that's the same whether it's a house or a car or, renting a motorbike. It doesn't matter. No one buys anything up front anymore.
Charles,
not just houses, anything.
There's a little ditty that I sent by email to all of the U.S. congressmen and all of the U.S. senators. Not that any of them read it, but it goes like this. When your outgo exceeds your income, your upkeep becomes your downfall. The important thing for the person making $70,000 a year to do is save $7,000 of it pre-tax.
Yeah.
That's the important thing. The idea that you take in 70 and you spend 73, which you finance and you can at 15 or 20%, is guaranteed penury.
Yes. Okay. And then gold, yes. Silver, I mean, in my mind, it's when you've got a 100-to-1 ratio, you're spinning a 1 ounce gold coin in your hand, or you can have 3 kilograms of silver. I think that explains why that moves. Platinum has been up recently. This year, yes. It's 40, 45.
Well, we talked about platinum a couple interviews ago.
We did, and we said it would move, didn't we?
But I reviewed the tapes in anticipation in case you guys tried to ambush me today. And platinum was just way, way, way oversold.
Yeah,
it was way oversold. We actually got this right in that interview. We talked about two things. One, the suggestion in financial markets that the internal combustion engine was going to go away and there would be no need for autocatalysts, which was silly. And the second was that periods of time of very low platinum prices for the last 40 years have corresponded with periods of time when the Russians needed money. Their little adventure in the Ukraine has caused them to need money. So the Russians dishoarded at the same time that headline demand fell, but it didn't take away the production risks in South Africa or Russia. The outcome was very, very predictable. And mercifully for us,
Rick, I'm going to take you back to the house situation because I have a bugbear about this. That yes, financially it is the right thing to keep your mortgage on the house, but surely, if it's your main residence, it feels much better to pay that debt off.
There is a matter of There's a matter of personal psychology. My wife would take your point of view, which is why I don't have a mortgage. But I'm old and fat and rich. The arbitrage between the return on capital employed that you enjoy during a period of rising interest rates and the free capital provided by a low interest mortgage can be offset by psychology. I absolutely get that. And for many people who don't have the discipline that I do with regards to their savings, they should probably pay off the mortgage simply because they would squander the surplus.
Yes, this is the other point.
For myself, when I had a mortgage, I was able, pre the first Trump election, to deduct the mortgage interest at the same time that I could invest the proceeds partially in pipeline partnerships and partly in short-term municipal bonds, and I enjoyed tax-free income. The idea that I could finance tax-free income on the back of tax-deductible fixed interest was, at my age, the most fun I could have with my clothes on. You know, I mean, it was it was just wonderful. But that was a financial construct. When they limited the mortgage interest deduction for old fat rich guys, and my wife expressed a preference for owning our house as opposed to having the bank have a senior lien, I had to, for the reasons you suggest, psychology, succumb.
Yeah, absolutely. Investing is not all just about this.
You're
is
right.
the right way. Sometimes, yes, it is absolutely the right way. But in terms of your main residence, for most people who aren't super wealthy, I would suggest that they would feel psychologically better if they owned what they have. Is basically that's it. In the same way as if I go into my small safe and pick out my gold coin, and I only have about 3 of them, but if I pick out my gold coin, I know that has a value. I've been buying silver, actually. I haven't got huge amounts of money, but been buying about 2 to 3 kilograms of silver every month. And that is basically what I'm hoping is going to happen with the silver price. And that is going to protect my value, if you like, my real purchasing power.
Well, Kevin, one of the things I hope you do with your bullion is I hope you open an account at Battle Bank so that you can use your bullion as collateral for credit should you need it. I'm not suggesting.
Does that mean I have to send it to you in America?
You do. You don't have to send it to me in America. You could store it at Brinks or Loomis in Great Britain.
No, but I live in Cairo, so that's a bit of a problem.
Well, you would have to store it in Brinks or Loomis in Dubai. Okay. We insist on Brinks or Loomis because we want our storage facilities to be in publicly controlled companies so that we can see the balance sheet and the income statement of the storage facility.
Yeah.
We don't want your bullion or our collateral to be taken away by an unscrupulous vault.
Yeah.
And from that
never happens, does it, Rick?
Let's say, for the sake of argument, I place, I don't have this much, but let's hope in time I do, £100,000 worth of bullion, okay, whether it be gold or silver. How is your battle bank going to work for me?
Think a margin loan. At the beginning of the discussion, we would set up a credit facility for you for 50% of the market value of your bullion.
Okay.
You wouldn't have to borrow against it. You wouldn't have to pay interest on it. You would have a facility that allowed you to draw it down as you needed it. So you don't have to pay interest on money you're not using. If the price of your bullion were to fall precipitously, you would get a margin call at 70%, just like you would with your stocks. Okay. You would have 5 days to cure that margin call the same way that you would with stocks.
If you take in the 50,000 loan and the bullion drops to 70,000, then I would have to pay some of that loan back, is what you're saying.
Correct. Or sell sufficient bullion that you could pay off the margin. We have reviewed 12-month periods for 50 years. And there is no 12-month period where we would have had to issue a margin call. You know, we're pretty picky about our collateral.
Yep, absolutely. So I could then use that money for anything, basically. So it's basically I'm lending, and then I can turn that money while still participating in the bullion price.
That's correct.
I can use that money then to create income from my bullion.
A lot of people have a lot of capital tied up in bullion. And I think that's a very good thing. There are periods in time when those same people need to access the capital to do something else, put down a down payment on a rental property, or whatever it happens to be, where there's some timely but intermediate term, 1 to 3 year use of capital. And having access to that capital prudently is, I think, a very good financial strategy. It's something that would have been very, very useful to me when I was a younger man and saved in bullion, but I was capital constrained in terms of the opportunity sets that were presented to me. There were opportunities that were available to me in the decade of the 1970s, the beginning of that decade, where I could buy rental properties at 100 times the monthly rent, fix up the property, increase the rents, and within 2 years finance out of the property on a non-recourse basis.
Yeah.
Those were superb opportunities, and there were opportunities that I had to forego because I didn't have access to all the capital I had.
Yeah, no, I can see it's a great idea. And how do you at Battle Bank make money out of that?
We take in deposits right now in the United States at roughly 4%. By the way, we pay interest on checking accounts too. And we lend that money out at prime. Prime now being, what, 7.75? The spread between 400 basis points and 775 basis points is our gross margin. And because we don't have branches, our non-interest expenses are quite low. In the United States, a well-capitalized bank is a bank that has 7% of its total assets in capital. So you're making, let's call it a 300 basis point net spread pre-tax. That's leveraged 12 to 1. It's a pretty good business. No, it's not. It's a really good business if you don't make mistakes. Banking.
How much do people have to pay to place their bullion in these places then? Is that an expensive ordeal or not?
No, it's very cheap. Very, very cheap.
Okay, no, I can see this would work. And there is literally billions of pounds or dollars or whatever currency you want to work out of gold and silver lying about.
We have identified $33 billion in segregated accounts in bullion in the U.S., and we don't know all of it. And ironically, there's no U.S. bank right now that's accessing that market for retail. I can certainly do it through Royal Bank of Canada at $10 million minimums, but a $10 million minimum is not a reasonable hurdle for most holders of gold, silver, platinum, or palladium.
Yeah, you're going to be looking for what? Somebody's got to hold how much to have an account?
In the beginning, the minimum account size that we will the minimum credit facility will require $100,000 in collateral. In other words, we will establish a $50,000 credit facility against $100,000 in bullion. Our hope is that as that business gets to scale, we'll be able to reduce that minimum to $10,000 or $20,000. At present, we believe that we would need sort of $150 million in assets to affect size efficiencies that would allow us to make that product available in $10,000 or $20,000 chunks.
Yeah, and I think there's a lot of gold in the Middle East as well. Dubai is full of the stuff.
We're going to do the U.S. and Canada first. Our last bank, by the time we sold it, we were licensed to do business in 28 countries. And our hope with regards to Battle Bank is that we will be able to do that over time, grow the way that Interactive Brokers has grown. But we're going to start in the U.S. and Canada, the U.S. representing, at last count, 23% of the world's savings and investment assets.
Yep, sounds like a good plan. So are you going to do the same with Bitcoin then or not?
We know a lot about the gold business, and our customer acquisition cost in the gold business is effectively zero. I'm a noisy guy. I'm well known. I talk on podcasts like this, and every time I do, somewhere between 30 and 150 people join the Battle Bank waiting list. Naked commercial, battlebank.com.
I was going to say this podcast should have a few more.
Yeah, this podcast is brought to you by Battle Bank.
Do you want to sponsor our podcast, by the way, Rick? Just while we're on.
What that means is that I'm competing with people who have a customer acquisition cost. And in Bitcoin, I would have that same customer acquisition cost. In the gold, silver, platinum, and palladium business, I'm a very well-known entity. And so my customer acquisition cost for that asset class is zero. And zero is a very attractive cost to me.
It's very attractive. I'm going to ask you a question now about one of the stocks that we've talked about before, which is Jubilee Metals in South Africa and Zambia. Have you got any thoughts on the fact that they're now pulling out of the tolling of the platinum and moving wholesale into copper in Zambia?
I think that the recent results that they've got in Zambia, I'm commodity agnostic. I want big deposits. Frankly, I'm okay with a big sand and gravel deposit if it's conveniently located next to a major metro. I don't care how I make my money. And while I'm in the near term probably still more attracted to the platinum market, I don't give a damn what I'm attracted to. What I hope is that my issuer will be involved in at least a strong tier 2, if not a tier 1 deposit. I don't like small mines. Both big mines and small mines have big risks. Small mines make you small money. Big mines make you big money. So whatever the management team thinks is their best probability of attracting at least a mid-tier 2 deposit, which I would define as in excess of $5 billion in situ recoverable reserves and resources, while being in the best half on a global basis in all-in sustaining costs and the best half on a global basis in return on capital employed. If a deposit meets those metrics, I care. If a deposit doesn't meet those metrics, I don't care.
I think what you're saying is it's too small for you, Rick. It's way too small an asset. But I want to mention sovereign metals, because I think last time you were on, you said it could be a 10-bagger if left alone. The Rio takeover, is the Rio takeover still maybe your best case, or maybe it isn't your best case? Maybe you'd be happier if Rio walked away from it.
Yeah, the Rio takeover is not my best case. If Rio came in and paid me a 30% premium or a 40% premium or a 50% premium, I wouldn't feel aggrieved. It's their job to look after their shareholders. By the way, I am one. If they didn't, and they allowed that asset to mature for whatever reason, that would be my preference. I love circumstances like sovereign. I understand completely that we are very early on in the value creation chain there. And I understand that lots can change in a country like Malawi. So when I look at sovereign and I ask myself, Rick, what is your downside? My downside is 100% if things go wrong. I lose all the dough I have in sovereign. I've done that before, more than once, by the way. What is my upside? We see the gross mineral value in that deposit as exceeding $20 billion, not 5. We see it growing. We see as they become more familiar with the ore body, the ability to optimize it and increase the overall grade with drilling density. And we see them progressing, albeit in fits and starts, in terms of process. That is to say, they're adding value. When I look at the upside in sovereign, in Meteoric, in Centaurus, in these stupidly large deposits in out-of-favor countries and out-of-favor commodities, When I talk about the fact that I have to acquaint myself with the possibility of losing 100%, I get to acquaint myself with the possibility that I make 10 times or 20 times or 30 times. And if you can have a small portfolio of disaggregated bets where your downside is 100%, but your upside is 1,000 or 2,000%, if you could afford that psychologically and financially, it's something worth doing. I remember well a conversation I had in 2011 when Eric Sprott bought my business and bought me. And we were having dinner together talking about our investment approaches. And I, being a veteran credit guy, a lender, said, in a business where the upside takes care of itself, what I do is I manage my risk. And he laughed and he said, that's funny. I'm exactly the opposite. In a business where my upside is dramatic as it is in mining, I realize I'm going to have some risks. If I get a couple that win, they amortize all my losers and they leave lots left over. And if the deposit is large enough, I've decided that Eric is right and Rick is wrong. I think my probability of doing that is in complex stories like Sovereign. There's a difference between your cost of capital in the rutile business, which most people can't spell, or the graphite business, which people don't understand, and the gold business. There's a huge difference between my ability to participate in a $20 billion deposit in Malawi, which people hate, versus Canada. So the probability that I'll have the right juxtaposition of risk to reward in a gold deposit in Canada is nil. The probability that I will be able to access those same odds in Malawi is high. When I look at the success that I personally have enjoyed in Congo since 1996, Tanke, Metarex, Motogold, Ivanhoe, being willing to risk 100% loss in return for a 20 or 30% gain, 20 or 30-fold gain, and understanding that I wasn't going to enjoy either the psychological or financial satisfaction in a 3 or 4 month time frame, but rather I would need to budget 60 or 80 months, has served me extraordinarily well.
There's a lot of retail that would not have the appetite for that, and that's why, as you say,
thankfully that's why I've been able to access it. I'm not trying to say that I'm smarter or harder working than a lot of folks. I'm just willing to accept a different time frame, a realistic time frame, and a different set of risks. And I've been punished. Russia treated me really, really, really well for 25 years until it didn't.
Yeah. The interesting thing is when you say 100% loss, you're not really talking about 100% loss, but you're talking about being wiped out. What things in Sovereign would need to be put in place, obviously, other than moving Malawi to Canada, which isn't possible? Okay, what things would they need to put in place that would start to basically take us up that scale of reduction of risk?
The value creation process is well underway. They need to continue to drill that deposit at the same time that they need to continue to work on process technology, at the same time that they need to engage with the local community.
Yeah.
The sociology, and I don't mean engage in them from London. At the same time that they need to work with the Malawian government around the mining code. Malawi has a very primitive mining code. They're going to need to establish a financial stability agreement with the government of Malawi. So that needs to happen. While that's happening, they need to continue to work on processing the two product streams and familiarizing the market with that output. When they're able to do that, I'm very certain that they will be able to construct offtake agreements, which will facilitate multilateral lenders to finance the thing to production.
And that ultimately is I think the plan when we've been speaking to Sapan is that, they're going to be able to prove to Rio they can do this themselves. Now, I believe if they get to that point, both political risk minimized, the financials minimized, the social thing minimized, which I think it has been actually. They've had a lot of success with helping farmers grow stuff and all sorts of different things. I think when those things have been minimized, then I see that the multiple that you'll be able to achieve, even with a sale to Rio, could be pretty significant.
I agree. From my viewpoint, having Rio as a large owner is reassuring in the sense that Rio did their own due diligence, so I have to do a little less. I'm willing to concede that the Rio guys collectively know a hell of a lot more than I do, so that's refreshing. What bothers me is it's very difficult to have an auction with one buyer. And I would prefer that China Non-Ferrous and Mitsubishi, Daewoo, I wish that there were a few people.
The Japanese guys come in and say, I want all the graphite, or I want all the rutile, or whatever. Yes. And I mean, those guys coming in and taking an offtake is gonna actually mean that even though it's only a letter of intent offtake, it's going to put sovereign in a very strong position when they are negotiating.
Yeah, unfortunately, you have Rio in the catbird seat right now. It's very difficult for Sumitomo or Vitol or Trafigura or anybody to compete in a fair fight.
Yeah, but my view on it is that regardless of which way it goes, as long as those risks that we discussed are covered, I think there's going to be multiple bags, if you like, from this price, because this price is very low at the moment, 35p or 34p.
I agree. I completely agree. I think your listeners need to acquaint themselves with the fact that these challenges won't be overcome by this fall. If you are somebody who has trauma holding stock over a long weekend, this is not a good stock for you.
But I think in a year's time, it'll be a completely different story, to be honest.
I don't know, because as it stands, definitive feasibility studies, we know how they go. They're not always on time. But assuming it does come in Q4, Rio Tinto has 180 days to decide whether to become operator. And if it does take that operatorship, at that point, I think a buyout then becomes inevitable. Now, if you're Sovereign Metals, you've got the next, let's say, 4 to 5 months to become your own competitive tension against Rio Tinto. You need to resolve the Malawi political risk, whatever that may be, get the off-takers, letter of intent, and then any other kind of issues that you might have, you need to resolve it and find a way to present that to the market. But that's the question: can they do it in the next few months?
I don't think there's a prayer that they can achieve a fiscal stability agreement with Malawi in 6 months. I don't think that Rio could do it. I think that they're going to have to involve the IFC and the World Bank, and perhaps Rio. So the idea that they can solve the key financial challenge in 6 months, even with a better feasibility study, I think is nil. The question is this sort of poker game between them and Rio. Rio is letting them de-risk the project, knowing that they have a call.
I guess it helps.
At some point in time, does Rio say, the more they de-risk it, the more we're going to have to pay. We should snap it up. Or is Rio distracted from other opportunities that they have, Simandou as an example, to add value to Rio? And I think it's an interesting poker game.
It is.
For myself, I like to view myself as the dealer. When both sides express fear, or particularly when the institutional investors express fear, I like to bet.
Well, the good news is they raised a decent amount of cash at the share price high. So, they're not, that Sovereign isn't sitting there, having to worry about money. But, I think that another company, it's in palladium, like PGMs, gold, nickel. And I believe you're invested in this one. We haven't talked about it before. Bravo Mining?
Yes.
Wanga? Yeah?
Yes.
Now, I've said it before, and I know you potentially don't disclose your own, position. Sovereign is one of, if not my highest position. I want to take a position in Bravo, but before I did, I knew we were having this call.
Yeah.
It's one of the most, I think one of the best investment cases out there at the moment. What's the risk there? I guess is the question.
At least three risks that I can think of. Well, four perhaps. Perhaps the march that we've enjoyed in the platinum and palladium prices reverses. Perhaps the exploration successes that we expect them to continue to enjoy on the platinum discovery. In other words, perhaps the upside case in exploration is false. There is a fair bit of market cap built in now in terms of their second type of exploration success, which is IOCG.
Yeah, I'm outside copper.
That came completely out of nowhere. And those drill holes and the geophysics that accompanied those drill holes, they were irresistible to me.
Well, we were talking, it was off the top of my head, I think it was 14% copper. Was it 3.3? I remember it was 3.3 grams of gold. And then there was another one that was 9.5% copper, and I think two grams of gold. It's crazy. Crazy.
It could be that those are one-off occurrences and that they don't have an IOCG deposit on the same concession that they have their platinum deposit on. Those are things that could go wrong. Brazil would seem to be a country that is, albeit gradually, improving. And certainly the infrastructure in Carajás is very, very good for mining and also improving. Access to hydroelectric power, access to rail, access to labor, access to roads, albeit shitty roads.
All of the best mines are next to shitty roads, and it always seems to be.
All of it's getting there. So that part is all good. The guy who runs the company, I have become increasingly familiar with and increasingly friendly with. I had the good fortune to interview him a couple days ago in anticipation for my upcoming conference where they will be presenters. And I need to say, he had familiarized himself with all of my prior interviews with him. And he was able to put his current comments in the context of the things that he offered up to my listeners 2 years ago and 3 years ago. It was a very impressive performance, particularly given that he's not a native English speaker. He is a very, very high quality guy.
That's all you want to hear. Okay, you've convinced me. I'm in. Bill, over to you.
Yeah, no, I think that's a really good one because I was talking to a big investor, someone who managed like a family wealth fund, and one of the comments he made was he won't invest in a CEO unless he's known him for at least 2 years. And I thought that it almost comes back to what you said, credibility, Rick, how well he carried himself, the fact that he wasn't a native speaker, you've got to know him over the years. But I want to just talk a little bit about uranium. We've seen quite a good, play on uranium of late in terms of pricing. You've talked, I think, in the past about, obviously you've talked about how you've done very well in uranium over the years. How do you see uranium performing? We've seen obviously demand increasing on uranium, with different the spot pricing. There's the different issues with it. Obviously, demand for nuclear as well and different power sources. And also, I think you've mentioned Denison mines in the past as well as one that you potentially is one of your speculative plays. But just give us a bit of a breakdown on where we are with uranium right now.
So uranium 6 months ago was really, truly hated. That was spectacular. If you looked in social media, there were a whole bunch of young morons who had uranium as part of their internet handles. And they were all capitulating. They were saying publicly, I wish I never heard of this stuff. It doesn't get better than that. If you believe in being a contrarian, there's nothing that you come to love more than hate. I had a very full uranium portfolio at that point in time. And so I bought more. And I bought it because I believed that the hate was temporary. I believed that over 5 years I would be right and the market would be wrong. The hate would evaporate and the stocks would melt up. That portion of my portfolio, which I added 6 months ago, which is about 25% of my total portfolio, I've now sold. I bought it because the sector was way, way, way oversold. I think the junior sector is temporarily overbought. I'm not selling my core position. because the uranium market has changed in a fundamental way that not one speculator in 1,000 understands, which is the emergence of the term market. The term market allows the Paladins of the world, the Denisons of the world, the uranium energies of the world to enter into agreements with credit grade counterparties for 5 years, 10 years, sometimes 30 years, which govern the volume and the price that they sell their material for. You can't do that in any other commodity. I'm a lender. If somebody comes to me with 60% of their production pre-sold for 15 years to investment grade counterparties, to Tokyo Electric Power, China General Nuclear, Duke Power, Southern companies, that's collateral. I know, particularly if the junior has a fixed price mine development contract with somebody like Westinghouse, I know that the arbitrage between their upfront capital expense and the revenue that we see from the contract guarantees that I'll be repaid. And what that means is that the builder's cost of capital, the issuer's cost of capital in uranium over 5 years will come to be the lowest cost of capital available in the mining business. It means something else too. It means that a lazy securities analyst, you're looking at one, Rick Rule, when he's constructing revenue and earnings models out 20 years, can have price and volume certainty in uranium that he doesn't have access to in any other commodity. This certainty allows you to pay up for speculative situations. It doesn't remove uncertainty, but it statistically reduces uncertainty to such a spectacular degree that I believe over the intermediate time frame that the whole sector reprices. And, you know, am I right about this in 2025? Who knows? I don't care.
Rick,
Okay.
I have a question. We're currently sitting with a war in Ukraine, Russia and Ukraine. We have a problem in Gaza. We've had problems between Israel and Iran. We've got a US stock market that's just hit all-time highs, 45,000 nearing for the Dow, 6,200 for the S&P, 22,888 for the Nasdaq. Small caps are up a bit. We're saying the VIX is very low, hardly any volatility. Is the US market sleepwalking into a disaster?
I'm not smart enough to tell you. I know about financial services and I know about natural resources. To me, the market isn't a subject. It's a facility. I use the market to buy and sell fractional ownership in businesses. I have no idea what Walmart is worth. I have no idea what Procter & Gamble is worth. I have no idea what NVIDIA is. I can't even spell it. So I don't have the ability.
It's worth $3.8 trillion.
No. It's selling for $3.8 trillion.
That's worth that.
I don't know what it's worth. Well, many people equate the bid with the value. I've made my whole life around arbitraging the difference between what something is selling for and what it's worth. I don't own the S&P 500. My own personal reflection in general market securities is what is for me a very large stake in Berkshire Hathaway and a reasonably large stake in an ETF called the Dividend Aristocrats, very high quality businesses that generate a lot of free cash and are polite enough to distribute some of that free cash back to their shareholders. So I'm not making bets on the broad markets. If you look at the Buffett indicator, Buffett's been pretty successful. First of all,
I saw that this week. Yeah.
The key Buffett indicator is that he has $300 and something billion in cash. But a second Buffett indicator is what he likes to describe as the delta between the market capitalization of the U.S. stock market and the size of the U.S. GDP. He points out that when the aggregate market cap of American equities is about equivalent to GDP, US annual GDP, that the market's cheap. And that traditionally, when it's twice GDP, the market is expensive. Well, right now it's twice GDP. So I'm not one to argue with him, particularly because he's been a successful investor across all sectors. And I've only been a successful investor in two sectors. I can tell you this, there are companies, mostly smaller cap, mostly billion, $2 billion market capitalization companies in the United States in sectors that are out of favor that are cheap, not kind of cheap. Cheap, 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 cheap. And they're cheap because
cheap.
The narrative around them isn't attractive to investors that have been schooled in the period 1982 to 2022. The growth investors, the technology investors. And I continue where those companies are available to, if I understand them well enough to know that they're cheap, buy them. Irrespective of whatever fears I might have for the valuation of the overall market.
Yeah, we see it that I think the valuations and the value is in the UK market is pretty extraordinary, to be honest.
I remember in the early part of the decade of the 80s, and I forget the name of the company, but market valuations were killed by very high interest rates. There was a Swiss company that operated aerial trams, stuff like that.
Mm-hmm.
And as I recall, the company was selling at about 25% of book. They were selling at 4 or 5 times earnings. And they had a double-digit yield. And I just remember that the rationale for this, well, I don't know what the rationale was. It was just too cheap. Could they grow? No, they couldn't build another tram, right? They were all built. Did I care? Given that earnings yield, given the fact that all they really had to do was operate the tram up and down the hill and collect tolls, there are times when there are extraordinary opportunities available to you in mundane businesses. And taking advantage of those opportunities, it's your responsibility to do so.
Indeed.
I remember in the listening to a Buffett talk, or maybe reading the annual report, 1981 or 1982, and he talked about the sixes. He talked about the efficacy of buying companies that were selling at 60% of tangible book, 6 times earnings, with a 6% dividend yield. He said if you could buy the 3 sixes, which he described as being available then plentifully, that your life was set. I think he described himself as an oversexed man in a house of ill repute, given the bargains that were available to him then. That occurred at the tail end of a bear market in equities from 1968 to 1982 that had most people, as a consequence of their past experience, too afraid to compete with Buffett in a market that was statistically cheap. If I had to guess right now, given the incredible optimism that one sees among equity investors and the more incredible optimism that one sees among bond investors, that I guess Buffett's opinion is expressed by how much cash he has.
Okay, well, Rick, I obviously want to mention one thing you mentioned at the top of the show, the Rule Symposium 2025 taking place on July the 7th to the 11th at Misner Center, Boca Raton in Florida. Excuse my pronunciation, not really familiar with it, but you will obviously be leading the agenda as founder and keynote speaker, bringing trademark insights on resource speculation and commodity investing. I believe attendees include CEOs and management from resource companies, including uranium-focused firms. Home Uranium confirmed with Roger Lematry presenting July 9th and 10th. So, yeah, I mean, do you want any more comments around that, the symposium, Rick?
If you're giving me a chance for a second commercial after Battle Bank, I'll certainly take it.
Go for it.
This symposium has gone on for about 30 years now. So we've stood the test of time. We've made it a little bit better every year. And if you do something a little bit better every year for 30 years, it ends up being pretty damn good. And the conference is indeed pretty damn good. Why? Well, first of all, we do big picture macro, different than the BBC and different than CNBC. We don't have journalists. We don't have influencers. We have players. Jim Rickards will talk about the conjunction between Wall Street and government. How would he know? He was chief counsel for long-term capital management, which damn near brought down Wall Street. We have David Stockman talking about the U.S. budget, U.S. budget deficits, the most important political issue for Americans right now. He's not a failed journalist. He ran the Office of Management and Budget under Reagan. He watched the derailment of the Reagan Revolution in 6 months by Republican and Democratic senators and congressmen. We have Nomi Prinz talking about the structure of Wall Street. How would she know? Partner at Goldman Sachs. We have Daniela DiMartino Booth talking about the Fed. How would she know? Is she an influencer? No. She was a researcher at the Dallas Fed. You follow me? So we have our macro done not by commentators or journalists or influencers, but rather by people who speak in a biblical sense from the belly of the beast. We move on to portfolio managers who've been active in resources and precious metals for 30 or 40 years, not people who learned to spell uranium 2 years ago, but rather people who've been through good markets and bad. They've stood the test of time. Every single public company at our conference has been vetted. If we don't own the shares, they don't appear on our floor. We turn down more issuers than we accept. The fact that we own something is no guarantee the price goes up, but there is a guarantee that we vetted them. At every other investment conference I know, the qualification to be an exhibitor is a check that cashes. They're just advertisers.
This is true.
Finally,
this is definitely true.
Whether you attend live or, as most people do, via live stream, by the way, we have attendees this year from 33 countries. Whether you attend live or live stream, we're going to give you 55 hours of programming in 4 days, more than you can possibly absorb. So the recordings will be available to you for a full year, and you'll need them. Believe me, you will need them. Also, to that end, I have interviewed personally online every exhibitor and every speaker, so that before you come to the conference, you can watch those interviews at the Rule Investment Media YouTube channel or at the Rule Classroom, so that you can allocate your time at the conference more efficiently, and allocate your time after the conference more efficiently. Finally, this: if for any reason you attend either live or via live stream, and you think that you didn't get your money's worth, email us and we'll give you the money back. This is a riskless transaction, riskless financial transaction. You don't get back 55 hours of your life. I can't do that. But the truth is, there is no other investment conference in the world that has the jam to say to you, full satisfaction or money back. After 30 years making the same guarantee, we've had to refund less than 0.1% of the tuitions that we've charged. But the fact that we make that unconditional, solid gold money back guarantee is your guarantee that you'll be satisfied with the product.
Sounds good.
That sounds like a good advert, Rick. I suggest that next year, maybe we do a podcast from your symposium.
I would be delighted. Next year is going to be better than this year. Next year,
we fly to Florida and come and see you. I think that'll be really
next year, the conference will be about the next legends. Every year we have a feature called the Living Legends, where we have my generation of entrepreneurs who have built multi-billion-dollar companies from scratch. You know, the Randy Smallwoods of the world, those guys, the Robert Friedlands, and it's great. Customers love it. What we're going to try and do next year is identify the 30-year-olds, 40-year-olds, and 50-year-olds who have already demonstrated enough success that they will be legends when they're in their 60s. I think this is going to be the most exciting conference we've ever had. That shouldn't detract you from coming this year, which is the best one we've had so far. But the conference that you propose to attend will be one where we try to be forward-thinking, as opposed to introduce you to people like the Lundins, like Friedland, like Bob Quatermain, like Ross Beatty, like Sean Rosen, who have been legends for decades. We're going to try to introduce you to the Amir Adnanis of the world, people like that, the people who have already enjoyed 2 or more successes, while still being young enough that they have legs.
Sounds excellent. Okay.
They all have legs. It's just whether they work or not.
Yeah.
Correct.
Okay. Well, I mean, we just would say to you, Rick, it's been, you're very generous with your time. We really appreciate you coming on and giving your wonderful insights. And so on that note, we'll say Rick Roll, CEO of Rule Investment Media. Thanks very much for appearing back on the roast.
Always a pleasure.
This podcast was brought to you by Roast PR Limited. If you would like to appear on a future episode of The Sunday Roast, please email admin@thesundayroast.net.